Hey guys, welcome back to a brand new episode of What's Happening. And with a show that's called What's Happening, it's quite hard to ignore the monumental catastrophe that's taken place yesterday. Now, it's not lost upon us that the fact that we get to be here in this studio and discuss crypto at a time like this is a massive privilege, and we do not take it for granted. But as many of our community members are new crypto investors who are wondering, how does something like this affect the markets? We thought it'd be worthwhile to just take a look. So why does the prospect of war affect crypto markets? In a similar vein to our episode on how interest rates affect crypto, it's worth noting that crypto investors are largely made up of two groups of investors. Fundamental investors who believe in blockchain and how it will change the world, and then there are speculative or algorithmic investors, as FTX chief Samuel Bankman-Fried explained on Twitter. Speculative investors aren't that interested in the fundamentals of crypto and see it more as a higher risk, high reward bet compared to equities. That's why there's such a strong correlation between stocks and crypto. So with that in mind, what are some reasons why stock and crypto prices are tanking? Well, the first is uncertainty. Wars like this generally create an overall sense of uncertainty, and uncertainty leads to risk-averse behavior. If investors are unsure of what the short-term future looks like, many may opt to liquidate their assets first and hold cash, or to move to less risky assets. While these decisions may seem rash in hindsight, in that moment, it may make the most sense. We can see the effect of this in the flight to safety happening right now, where investors are flocking to safe haven plays. Gold prices, for instance, surged yesterday, hovering over a one-year high. Besides uncertainty, another factor affecting the markets is the potential for inflation. Now, most of Europe gets a significant portion of its gas supply from Russian pipelines. As countries move to cut off Russia from the world as part of sanctions, these countries will stop using Russian gas and look elsewhere for alternatives. And as you know, when you decrease the world supply of gas and increase demand for other sources, prices are going to soar. This will affect everyone, as energy and fuel prices will go up, and if prices are expected to rise, retail investors may decide to hold on to more cash if they are expected to spend more in the coming months. Businesses are also affected as the cost of production will increase, and so the economic or financial outlook for businesses is going to be less rosy than it was pre-invasion, causing stock prices of these businesses to drop. And given the correlation that we spoke about earlier, crypto prices will most likely follow suit. Ukraine is also the third largest supplier for corn and the fourth largest supplier for wheat in the world. And so with war, the supply for these goods are likely going to shrink, thus causing prices to rise. Last but not least, there's also potential regulatory risk that may affect crypto markets. While it hasn't really been discussed broadly yet, there is a potential risk towards crypto as nations continue to cut Russia off from the world. An option for a sanction that's being heavily considered, although not yet imposed on, is to cut Russia off from SWIFT, the financial system that enables global payments. You know, when you ask someone for their SWIFT code, that's the one. Ukraine has already urged the US to bar Russia from it, which will prevent Russia from taking international profits from its gas sale, about 40% of its revenue, plus from getting supplies from friendly nations during war. If the SWIFT barring takes place, it may lead Russia to turn to crypto as a way to transact internationally. Doing so may lead Western nations to take a harder stance on crypto to further cripple Russia. That being said, war doesn't always lead to poor market performance in the near future. We have a handy table here illustrating a history of previous global crises and the impact of the Dow Jones Industrial Index. Most of the time, markets rebounded within 3 months. Investors also would have known by now that markets do recover eventually, particularly after events like 9/11 and COVID. And so with level hits, hopefully markets won't tank so far. Other graphs also show that markets tend to bottom out before an invasion takes place. Sometimes it's also self-fulfilling prophecies and speculation, the narrative in the media and on social media that an invasion will affect the markets before it even happened, causing investors to sell off upon hearing the news. This is similar to how in stocks, the anticipation of an announcement is the announcement itself. It's like how when you're looking forward to Apple announcing new MacBooks, that rumor is usually the announcement that usually people trade on. So you're probably wondering, now what? We polled the Chain Debrief community on whether they would buy the dip, and the majority of respondents said that they were holding out and waiting for more updates before making any moves. But here are some general rules of thumb to follow when in a bear market. If your conviction in crypto is high, you can consider dollar cost averaging and continually putting in your money over time. Volatility is crazy in the crypto market, war or no war. And one way to avoid this is to look into stable farms. Consolidating a portion of your portfolio into stables might be a defensive strategy worth looking at, and prepare for the incoming or upcoming market recovery. At the end of the day, please remember to manage your risk and portfolios accordingly. While indicators have shown that the markets do recover significantly, no two situations or 5 situations, depending on the graph you're looking at, are the same. And it's impossible to accurately predict what exactly will happen. Thank you so much for watching. Take care, stay safe, spend time with your loved ones. We'll see you in the next one. Bye-bye.